Now, with this in mind, it brings you to the cyclical nature or the cyclical asset management approach, and understanding that everything has a cycle to it, a cyclical nature of the environment as well as stocks and other investments. And simply put, we think of it as everything has a peak and a trough, an early downturn and an early upswing, and a full upswing and a full downturn, and then we cycle through again. And I've shown you that with different types of asset modeling that we do in previous meetings, previous reviews. But let me put it in terms that might make a little more sense. If you think about it for a second, for instance, cash reserve, which is going to be attached to interest rates. If we were sitting here and you were sharing with me right now, and I said to you, where do you think interest rates are right now? Do you think interest rates are at the peak, or do you think they're at the trough? You probably have some opinion. You may not, you may be more right than I am, to be honest with you, but you have an opinion whether you think interest rates are at the top and going to go down, or whether they're at the bottom and going to go up. Or maybe they're somewhere in the middle. Maybe they're on the way down, or maybe they're on the way up. You have an opinion. And that opinion is how we start the discussion about managing money. So for instance, let's say that with interest rates and using cash reserve, if you said to me, I think they're at the peak, I would say to you, do you think that means they're at 12 o'clock? We'll call the peak 12. We'll call the trough 6 o'clock. Do you think they're at 12 o'clock? Do you think they're at 11 o'clock? Do you think they're at 1 o'clock? 11 o'clock meaning you think they might go a little higher. 1 o'clock meaning you think they're on their way down again. You see, that's a starting place for our conversation. I'll show you why that's important here in a minute. But that asset, cash reserve, CDs, money markets, understanding where interest rates are is an important part of this discussion, because when we go to bonds, for instance, would their valuations be at the peak or the trough? Would they be at 12 o'clock or 6 o'clock or some other number? Now, most people, when I ask this question, they say, I have no clue. I don't even know what drives bonds. Let me tell you, it's connected to interest rates. I mean, there can be other factors that might impact it, but if interest rates go down, bonds go up in value. And if interest rates go up, bonds go down in value. So if you said to me, well, I think interest rates are at the peak, that would mean that bonds are at a low point and would begin heading back up if interest rates start to go down. And that gives us some clues as to what some of our next moves should be if we're trying to manage assets appropriately. If you said that I think the interest rates are at 2 o'clock, meaning they're starting to head down again, that means we should start to see bonds move up in value. And if we see that, that should give us some ideas of how we might want to weight, W-E-I-G-H-T, a portfolio for more growth, income, or opportunity. Now, if we look at interest rates and bonds, the next area would be stocks. And if I said to you, do you think the stock market is at 12 or 6 or some other number? Again, you have an opinion, and all of us do, and your opinion may be right, or it may not be, but it's that place to start that and say, well, how would I diversify my portfolio? If I think stocks are at the top, then I probably should be looking at other opportunities on how I manage it. This is how we do it, and I try to, as a person who's practicing a fiduciary standard, trying to say, how would you see this so we can then match it up, which is critical. We will do what we're supposed to as professionals, but we're not going to supersede what you say. You're the boss. We're the employees. I'm going to tell you everything that I know. I'm going to give you the benefit of all the information I have so you can make an informed decision. But in the end, if you say I'm just not comfortable with that risk, we're going to go with a lesser risk, even if I'm convinced it's not the best move. Because again, this is your money. You've worked hard for it. Our job is to help you understand what to do with it, to guide you in the process, to lead where we can, and then help you understand what opportunities you have next, or what we should do if things change on us and they're not going where we thought they would. So again, back to stocks, 12 o'clock, 6 o'clock, or some other number. The same thing's true with real estate. It has a peak and a trough. And with stocks, for instance, we have large cap and small cap, mid cap, we have growth and value and blend. With real estate, we have multifamily, single family, we have storage, we have A-class, B-class property, we have senior housing. There's all kinds of different real estate opportunities that exist out there as well. And they're cycling, just like sometimes on that previous chart you saw that large company stocks were at the top and smaller company stocks were further down, or vice versa. Same thing's true with real estate. Sometimes multifamily is doing a better job. Sometimes storage is doing a better job. Sometimes A-class properties are doing a better job. And sometimes they're not doing good jobs at all. But understanding that mixture, how that fits into this thinking, is when we look at real estate, would we say real estate is at the peak or the trough or somewhere in between? Is it at a 12 o'clock, at 6 o'clock, or some other number? And again, as we talked a moment ago, if interest rates are going up, it might make it harder to purchase real estate because it might be harder to get a loan that you can afford. So that might mean that real estate, if interest rates are high, real estate might be down more in the trough area, which means it has an opportunity to cycle and go higher. But it might not be this month, it might be 6 months. That's where the waiting and waiting comes in.